Hello and welcome back to Revenues, Expenses, Dividends, and Basic Financial Statement Creation. This is part 3, which is going to be talking about dividends, and we're going to start our comprehensive problem in terms of recording the transactions into the T accounts, and then we'll do an unadjusted trial balance. Disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation with others on an unmodified basis. If you decide to modify the presentation in any way, please email me prior to doing so at bennett1812@gmail.com to discuss. Note that I do not claim as the author any copyright whatsoever in any companies or organizations mentioned in this presentation, the other parties. Rather, the other parties are the owners of their respective copyrights. So up until now, we did a comprehensive problem, which was Duey, Suem, and Howe. We've been recording asset, liability, and equity accounts, and with revenues and expenses using T accounts, where we've prepared an unadjusted trial balance, an income statement, a statement of retained earnings, and closing out the temporary accounts to retain earnings, and a post-closing trial balance and balance sheet. So there's one other concept that I'm going to introduce right now, which is the concept of dividends. And then we're going to look at a very much of a grander, larger problem to help illustrate all these kind of concepts in terms of going through. One of the things you're going to notice in terms of where we are so far is I'm intentionally doing things such as if I'm loaning somebody money or if I'm borrowing money, I'm doing those on December 31st. I'm also doing things like purchasing equipment on December 31st. If I bought an insurance policy, I'd be buying it on the very end of the year. The reason for that is that we're not dealing yet with adjusting journal entries. That's going to come in our next segment. The adjusting journal entries are adjusting journal entries. We're not there yet. I'm more concerned with you learning how to record assets, liability, and equity transactions. How do you record expenses? How do you record revenues? How do you go through and prepare financial statements? So the last concept we have here are dividends. What exactly is a dividend? A dividend is a way that a company can give back to its shareholders by distributing the net income that it's received. And if you kind of go back to our last example on Duey, Suem, and Howe, they had net income of $95,000. And while that $95,000 is staying in the corporation, that's great, but do we want to give some of that back to Ivana and to Chase? So with dividends, it's very important to know that it is not mandatory. It is a board of directors decision. Dividends do decrease retained earnings. And if you think about our statement of retained earnings, we have beginning retained earnings plus net income minus dividends gives us our ending. It's non-deductible for tax purposes to corporations, and it is taxable to shareholders. And that may have changed under the tax law, but that was the tax law pre-2018. Dividends, it's very important that we do not include them in the income statement. And when we look at the income statement, that's really telling us what our revenues and expenses were for a particular period of time. If we're paying a dividend, that's not an expense. We're returning net income to the shareholders. So that's why it does not go on the income statement. Now, you might be saying, well, what if we have an investment and we got a dividend? Hey, that's great. That's intermediate accounting. That's not right now. Or maybe owner's equity. So very, very important. They are not an expense. They're going to be reducing owner's equity as a reduction to retained earnings. And dividends are a temporary account similar to revenues and expenses. And we're going to be closing those out to retained earnings at the end of the period. Now, even though a dividend is not on the income statement, I kind of like to say we're going to debit dividends. Why, or DD? Is that because when I pay out a dividend to a shareholder, my cash is decreasing, so I'm going to show that as a credit. And over here for this debit, I'm going to be debiting dividends for the 17 grand. And this will show again as a reduction to retained earnings because I'm distributing back part of that money that I've earned back to the shareholders. So coming back here to our basic financial statement creation, we're going to follow these same steps for this one particular video. And again, we're going to record the transactions into the T accounts. We're going to prepare a trial balance, and we're going to use AE, LOE, and then we're going to do revenues and expenses. We need to make sure our total debits equal our total credits. And that's where we're going to be stopping today because when we go through the example, this is the comprehensive problem I'm giving you. So this is letters A through N. I pulled this from one of my old exams. That looks like a lot of fun. And it's just really so we can go through and really kind of understand is, how do we go through and record each of these various different transactions. So with that being said, I'm going to pause really quickly and we'll go to our Google Sheet. Okay, so we're back. So our first transaction here is on January 1st, 2020. Timmy and Larry each contribute $105,000 cash to IRI in exchange for common stock. Now, if you're in my class and you're taking an exam, I will give you these various different accounts, but this is something you shouldn't even have to be looking at anyways. So let's go through here. So Timmy and Larry are each contributing $105,000 cash. So let's go up here to cash. I'm getting $105,000 from Timmy, and then $105,000 from Larry. And this part right here is I'm showing here as cash. And again, when we go look at our T theory of accounting, what exactly is our T theory of accounting? I'm going to pause real quick. So our T theory of accounting is that when I have cash or if I'm increasing cash, I'm going to do so with a debit. And so here they each contribute $105,000 in exchange for common stock. So what I'm doing here is I'm going to be issuing to Timmy and Larry common stock for $210,000 or $105,000 from each. Okay. So at this point in time, as I'm going through and doing this, if you've been watching the other videos, some of this should be coming really, really quickly. The key is with accounting, you don't want to hesitate. How do you not hesitate? You practice, as taught to me by my 9-year-old son when we're studying for our spelling tests. Okay. March 1st, 2020, we perform consulting services for a client, RGI, and we send an invoice to RGI for $40,000. With this particular transaction is I've performed the service. Remember what we said about revenue. It doesn't matter whether or not we've actually been paid. The question is have we actually gone through and have we performed the services? So in this case right here on March 1st, 2020, I've performed the services. So what I'm going to do is I'm going to recognize here services revenue. And I'm going to recognize the services revenue here with a credit for $40,000. Now, as we note here in this transaction, is that I performed services and I sent an invoice. What that means is I have not yet been paid in cash, but what we saw from the other videos is that an invoice represents, kind of shows that I've actually done the work, and I performed the consulting services, so I'm sending them an invoice. So right here, I'm crediting services revenue for $40,000. I'm not getting cash, but instead I'm owed money, and this is going to be accounts receivable. And this accounts receivable will be here for letter B of 40 grand. So again, I'm debiting accounts receivable, which is an asset, meaning that the client is ultimately going to have to pay me, and I record revenues with a credit. Okay. So going back over here to letter C. Letter C, I receive an invoice from a consultant that I hired, MDI. The invoice is for $15,000. I'm paying 20% of the invoice in cash and I will pay the remaining balance in 150 days. Okay, so somebody performed services for us. I got an invoice that I hired from MDI, and the invoice amount is $15,000. This is what we call a consulting services expense. So right here, we're going to have consulting services expense. We hired Mary David Inc. to do services for us, and so therefore, regardless of whether or not we've paid the cash, remember the cash has really nothing to do with it. If I've received the benefit of the services, then I need to record the expense. So the invoice amount is for $15,000. So I'm going to show this here for 15 grand. Now, for every debit, I need a credit. What's interesting about this one particular one, though, is that I'm not paying for the entire thing in cash. I'm paying 20% of the invoice amount in cash, and I'll pay the remaining balance later. So right here for transaction C, right here, the amount due is $15,000. The amount in cash is going to be 20%. So the total cash being paid is $15,000 times 20%, or $3,000. So for every debit, I need a credit. I'm going to credit cash for $3,000, and this will be transaction C. Now the problem is that do my total debits equal my total credits? No. So what I need to do here is I need another credit here for $12,000. My amount owed is going to be this $15,000 minus a 3. And this is going to go to accounts payable. So right over here, I'm going to create a T account for accounts payable for $12,000. And this will also be here for transaction C. Note that when I'm going through and doing this, in terms of, I'm just going to highlight this because it's important. I have total credits of $3,000 and $12,000, which equal $15,000, which was the amount of my expense. So again, I paid $3 grand cash, I owe $12,000. So that's how we're going to go through and record transaction C. Why is it an expense? I've received the benefit of those services. Okay, letter D. On June 1st, 2020, we hire a consultant, McLaughlin McNeil. I give McLaughlin McNeil $35,000 for future services to be performed by MMI. So I'm hiring them and I'm giving them money. So let's do the easy part first. So the easy part first is going to be cash. I'm paying them for future services to be performed. For every credit, I need a debit. Now, is this consulting services expense? I have hired them, but they have not yet performed the work. I'm giving them an advance. So what we're going to call this is going to be called prepaid consulting services. And this is going to be here for $35,000. This is transaction D. Note, the language becomes really important as you go through and do these questions. I hired a consultant. I'm giving them 35 grand for future services that they will be performing. Okay, so that's letter D. Letter E, on July 1st, 2020, from the transaction in letter B, they pay us $30,000. So I'm receiving $30,000 from RGI. So what's happening to my cash? Well, I'm receiving $30,000. And this is letter E. Now, a common mistake that most students will make is they will go through here and they'll record this as services revenue, but that's not correct. The client owed me $40,000. Okay, so this client owed me 40 grand. However, they're giving me $30,000. So how much does the client owe me now? Well, the client owes me $30,000. Excuse me, now they owe me $10,000. So when I'm collecting on prior services performed, what I'm going to do here is I'm going to debit cash for the 30, and then I credit accounts receivable. And if you think about this logically, at this point in time, how much is owed to me from that client? Well, it's 40,000 minus 30,000 or 10,000, which kind of makes sense. I did services of 40,000. They paid me 30 grand. Now they owe me 10,000, which if I netted this out, this would be $10,000. Okay, that's letter E. Letter F. I perform consulting services for a client, 49ers Inc., and I sent an invoice to 49ers for $120,000. So this is very similar to transaction B, and in fact, it's so similar, we're going to record it the same way. So here, this is 120,000. This is letter F. So I'm going to debit accounts receivable for 120,000, and then I'm going to credit services revenue for 120,000. That's how I go through and record the transaction. Once I've gone through and performed the work, I can go ahead and recognize the revenue. I'm crediting services revenue for 120,000 because that's how I record revenue. If I was getting cash, I debit cash, but in this case, I'm getting a promise to pay in the future. Accounts receivable is an asset. It typically happens when we're dealing with services revenue. Okay, that is transaction F. Sorry for going back to that. Transaction G. IRI pays the remaining balance owed to MDI from transaction C. So we go back up here, we go to transaction C, and how much did we actually owe them? Well, and what letter is this here? Yeah, okay. So if we go back to transaction C, I still owed them $12,000. So if I'm paying off the amount that's owed, I'm going to credit cash here for $12,000. And this is going to be letter G because my cash is going down. But again, this is not an expense. Rather, I recorded this account payable from transaction C of 12,000, and that's what I'm now paying off. So here I'm going to debit the liability or decrease my liability because I'm paying this down. Note here my cash is decreasing because I show that here with a credit. So for every credit, I need a debit. And in this case, it makes sense that my liability is going down. I owed them $12,000. I'm paying them 12. So now my balance here is going to be 0. Okay, that was letter G. Letter H, I received $75,000 from a new client, Raiders Broncos Inc. I'm going to be performing the work in the future. So here for letter H, I'm receiving cash, but I haven't done the work. So what do I need to do? I'm getting money. This is going to be letter H. And do I credit revenue? No, I don't credit revenue. Why? Because I haven't done the work yet. So what I need to do is I need to book this into unearned revenue. And I'm going to credit unearned revenue for $75,000. What kind of account is unearned revenue? This is a liability. I've gotten the money, but I have not yet performed the work. I received the money from a new client, but I'm going to be performing the work in the future. So I cannot record this as revenue because I have not yet done the work. So instead, I'm going to be recording this as unearned revenue. Okay. So letter I. On November 1st, 2020, I received $20,000 in inventory. That will be resold in 2021 from Chargers Lambs Inc. I receive the inventory on the account and the balance will need to be paid in 90 days. So right here, I'm receiving inventory. And this is letter I. Inventory is an asset, meaning that it's going to be something I'm going to be reselling in the future. So here, I'm going to debit inventory because it's an asset for $20,000. Am I paying cash for this transaction? The answer is no. How do I know it's not? It says here clearly on account. Okay, so if it's on account, it means we're going to be putting this into here or accounts payable. So this is letter I. Okay, really important to go through and do that. I'm receiving an asset, so I'm showing that increase to my asset with a debit. At the same time, I'm increasing my liabilities. I have to pay back this $20,000. I'm going to show that increase with a credit. Let's take a look at transaction J. I declare and pay a cash dividend of $9,000. So what's happening here? Remember from before we were talking about what we call debit dividend. So this is going back to the earlier discussion, which is going right back to, wow, we were doing this. Okay, right here. So I'm going to be debiting the dividend. So my dividend that was declared and paid was $9,000. So here, I'm going to credit cash for $9,000. And this here is going to be transaction J. So for every credit, I need a debit. And what I'm going to be debiting is dividends for $9,000. Okay. My next transaction after transaction J, I just want to make sure I keep on doing this right here, on letter K. I pay my landlord $3,000 for office rent. And this is really kind of poorly worded. I would need to actually say office rent for the month of December. So right here for letter K, what I'm going to be doing is what's happening to cash. Cash is going down by $3,000. Okay, so I'm crediting cash for $3,000. What do I go through and, sorry about this. So I paid for my office rent, which cost $3,000. I don't own the office space, so instead over here, I'm going to call this office rent expense. This is letter K, and this here is going to be for $3,000. How do I know it's right? If I'm paying cash for something, it's decreasing the asset here with a credit. How do I record an expense? I used the office space during the month of December, so I'm going to go ahead and make that a debit, and that's how I record expenses. Okay, so now going back over here, that's letter K. Letter L, I pay for an electric utility bill for $2,000 in December. I should say that's for, I paid $2,000 for an electricity bill for the month of December. We can make this also clarified up here. So I paid $2,000 for an electric or utility bill for the month of December. What's happening to cash? Well, right over here, cash is decreasing. So I'm decreasing cash because I'm paying for my utility bills. And this here was transaction L. For every credit, I need a debit. In this case here, because I use the utilities expense, I'm going to record this with a debit. So this is very similar to how we just recorded our office rent expense. Okay, and then here we have on December 31st, so Chuck contributes 50 grand of equipment in exchange for common stock. So what's happening here? Well, if I go over here, I'm receiving equipment. The equipment here was valued at $50,000. I'm receiving equipment, which is an asset. Okay, so this is transaction M. So for every debit, I need a credit. What am I giving for this equipment? I'm giving common stock for this equipment. So right here, I'm crediting common stock for 50 grand. So that's how I record transaction M. And then over here, I loan Patriots Lions. So I'm loaning $7,000 to Patriots Lions. Patriots Lions will repay me in 120 days at an interest rate of 8%. If you've watched the other videos that I've done, I also had a question that was like this. When I'm loaning money to somebody, right, so my cash here is going down. My cash here is decreasing by 7,000, right, because I'm loaning money or I'm giving money to somebody. And then here what I'm going to be debiting is going to be loan receivable. And this here will be for $7,000, and this will be transaction N. So at this point in time, what I'm going to do here is I'm going to make a trial balance. And this is going to be an unadjusted trial balance. And after we do this, I'm going to pause the video and I'm going to start up a new video just because I think this can be a little bit too much. But I at least wanted to do this first part right over here. So to do our trial balance, we're going to have IRI trial balance as of 12/31/17, or excuse me, 12/31/20. The way I want to set this up is I'm going to have my assets, my liabilities, owner's equity, revenue, and then I'm going to have my expenses. Why am I setting it up this way? Because if I set it up this way, my life is going to be significantly easier. Do I have to set it up this way? No. In fact, you can just dump everything onto it. Doesn't really make a difference. But for our purposes here, we want to set it up this way because it's going to make it a lot easier for us to later go back and do the financial statements. Okay, here, so for cash, the first thing I'm going to go through and do is sum up my various different amounts. Now, when I'm using T accounts right here, I'm taking my total debits and I've got my total credits. This is just a sum here of everything that I've gone through and paid for. This is a sum here of the 210, 30, and 75. I subtract the smaller from my larger balance and I end up with an ending balance of 224,000. This is the balance that's going to go over here, or cash, and when I do my trial balance, my cash balance here is going to be 244,000. Okay. Common stock. Where does this account go? It's part of owner's equity. So here I've got 260,000 credit. So my trial balance, I'm going to put this here, common stock, 260 credit. Services revenue. I add up these two amounts here. I get $160,000 credit. So here for services revenue, I've got a revenue here of $160,000 credit. Okay. So now I'm going to go to accounts receivable. And here for accounts receivable, I have 30,000 in credits, 160,000 in debits. My ending balance and accounts receivable is going to be 130,000. So what I do now is I'm going to put accounts receivable, which is an asset, meaning that customer has to pay me in the future, of 130,000. The next thing I'm going to do is I'm going to total up consulting services expense. Right here, this is going to be $15,000. I'm going to put my consulting services expense right here as a debit. I have accounts payable. For accounts payable, I have total debits of $12,000, total credits of $32,000. My ending balance in accounts payable is going to be $20,000. Remember, I'm subtracting the smaller from the larger, and I end up with the remainder being on the larger side. So right here for my liabilities, I'm going to have accounts payable, and that balance here will have a $20,000 balance. My next one is unearned revenue. That is also a liability. My unearned revenue here has an ending balance of $75,000. My unearned revenue has a credit balance of 75 grand. My prepaid consulting services has a balance of 35,000. What kind of account is this? Prepaid consulting services is an asset. It's giving me future economic benefit. I've paid for services in advance. Similar to an insurance policy where I haven't gotten the benefit out of it. Okay. Next one's over here is I have inventory. What type of account is inventory? It is an asset. So my total inventory here is going to be a debit here for $20,000. Dividends. Now, when it comes to dividends, where exactly should we be putting them? I kind of like to look at them in no man's land. They are not an expense, but they're not really a part of owner's equity. So I'm going to kind of wedge them in between here, between my revenue and my balance sheet accounts. Office rent expense, again, this is going to be an expense. And so my ending balance here was 3,000. I know for many of you, this is like absolutely excruciating, but it is so, so important that you do it in whatever way you're going to do it, but you have to kind of follow this along. If you don't do these steps, it's going to be a nightmare. Okay, so that's my office rent expense. It's an expense. I'm going to list it there. I've got my utilities expense. My utilities expense totaled up to be $2,000. My equipment totaled up to be $50,000. And then I have a loan receivable totaling up to $7,000. So the utilities expense is going to go here into my expenses, and that will be at $2,000. And then here I've got my equipment account. My equipment account here will be at $50,000. My loan receivable will be at $7,000. Now, many of you who are taking more advanced classes might be freaking out because you might say, oh my God, Tchaikovsky, like, what about if it's current or non-current or whatever may have you? I'm not concerned about that yet because we're still trying to learn the basics. Once we have the basics down, then we're going to be able to go through and figure out the rest. So I've gone through and I've input in all of my transactions. So let's go see if this actually totals up to be correct. Frankly, I have no idea. And if I haven't done it correctly, I'll probably have to pause and come back to the video. But right over here, we've got a total sum of, we have total debits right here of 515,000. And we have total credits here of 515,000. Yay, it's exciting. So we've done this part here. And this is where I'm going to stop the video just because these videos will go on forever if I don't stop. So this is our trial balance. And now that we know that our total debits equal our total credits, we're going to then take our next steps, which is going to be the creation of the income statement, statement of retained earnings, and then the balance sheet. But I will see you on the next video and see you soon. Thank you.